your third top trend of 2022. You're talking about global debt trap deepening. You've talked a lot over the last 3-4 years about global debt, but the trap now has deepened. If you just look at the data, it is shocking. According to your data, spiked during the pandemic.
Yeah, it spiked during the pandemic and has taken even more countries deeply into debt. So you can see here the trend over the last 2 or 3 decades that, when I first got into this business of investing, there was not a single country in the world which had a debt to GDP ratio of more than 300%. Today, there are 25 countries.
You're talking about 1998 where there was zero, but you were not born in 1998, were you, Ruchir?
Well, yeah, I mean, it's back to 1995, in fact, when I started investing. But yeah, at that point in time, there were no countries with a debt to GDP ratio of more than 300%. Today, there are 25, from China to Japan, United States, a whole bunch of European countries. And that is a very big reason why it is so difficult for interest rates to go up. We are so dependent on debt, on servicing that debt, that I think it's a real problem.
Pointed out that India's debt is high for, if you compare them with similar economies. Look at that. Vietnam is higher than us, but Egypt, Indonesia, Bangladesh have a much lower debt as a percentage of GDP. So India's debt as a percentage of GDP is 175%. That's very high.
Yeah, these are total debt numbers. It includes government debt, all the private sector debt, which is corporate and households. So we put all the data together out here, and I think that at one level, the fact that India's debt to GDP ratio is not above 300% is fine, but generally the lesser advanced countries tend to have lower debt to GDP ratios, and for a country with a per capita income of just under $3,000, India's debt to GDP, overall debt to GDP, is quite high, largely because of the government debt. The government and the related sectors their debt levels are relatively high for a country of this per capita income. So that's something which is obviously concerning. The only good news there is that most of the debt is owned by domestic institutions. Very little of this is owned by foreigners. So when that happens, at least the currency tends to be more stable.
And one of the things that comes out of this, you say that interest rates really don't have very much room to rise any further. I mean, if you look at global stocks and bond markets, how much they've grown, compare them with GDP. In 1980, they were just about the same as GDP, a little more. Now they're 4 times GDP. That's just huge.
Yeah, this is the double-barreled effect that higher interest rates can have, which is that if interest rates go up, not only does that really hurt you on the debt side because there's so much debt and it becomes harder and harder to service that, but also the fact that the stock markets, the bond markets around the world are so big and so much of that is dependent on a very low interest rate environment. So this is something that we have to be very sensitive about, that if interest rates start to go up, both the asset markets and the debt serviceability becomes a lot more difficult.